Yeah, we think investors are starting to become more comfortable adding duration. Bond yields, both nominal and real, remain historically high, and that provides a nice cushion to potentially higher interest rates. With the worst of inflation likely behind us, and with growth concerns coming more into focus, bonds can assume their role as a diversifier to investors' equity exposure. So, where to invest on the curve? That decision depends on one's expectations for inflation, growth, Fed policy, and perhaps some consideration of future budget deficits. The Treasury curve right now remains relatively flat, so to extend duration means investors are giving up some current yield for potential price appreciation. For those who believe that inflation will remain sticky and the Fed will keep rates higher for longer, staying shorter certainly makes sense. But you do have to keep in mind reinvestment risk if rates come down, especially if you're in the very short end of the curve, such as T-bills. Now, our view is that a soft landing remains the most likely outcome for the market. With growth and inflation moderating, that should allow the Fed to stay on a steady easing path. But we have bumped up our odds of a more significant slowdown, or what we're calling a growth scare. So given that, we're finding the best risk reward in the 5 to 10 year part of the curve. We think that offers a nice balance of good yield, and it should benefit from Fed easing and potential curve steepening. It also provides enough duration to hedge against a potential downturn in the economy without extending too far out to the 30-year part of the curve, which could be affected by concerns over spiraling budget deficits. Although the deficit, we think, is likely a longer-term issue for the bond market. In sum, we think bonds offer good value here with the best opportunities in the intermediate part of the Treasury curve.